Blame it on the yen. Blame it on the yen. What happened? The market took a big dip today after going through a pretty negative downward trend all of last week. And once again, for today, we can blame that on the yen. What happened? The unwinding of the carry trade. So, interest rates in Japan were close to 0%, very low, and people took out loans in yen and then bought assets with it. So that was a great strategy for them until Japan decided to raise interest rates and apply a little bit of economic stimulus. So now those loans are being called back and people have to repay their loan that was in yens. And the only way they can repay the loan is to sell the assets that they bought with that loan. And so a lot of them are tanking the markets, trying to get their cash back so they can repay that loan that's in yen, and others are getting margin calls, and then that sets up further margin calls for people that weren't even involved in the yen trade, and that's what have kind of set markets lower today. But overall, we're going through a little bit of a period of some unknowns, election season coming up, and we're not seeing those green days, up days every single day for months at a time. So we're starting to see a mixture, and it's okay. We don't always have to be at all-time highs. And there's things that we can do, strategies we can employ to avoid the problems that are associated with a market downtrend. I'm in my kitchen, and there's three strategies that the items in my kitchen remind me of. And the first one, an apple. You might say groceries. How is that going to help things? But actually, I'm talking about buying Apple. The stock, it was down 5% today. I'm also more a proponent of the index funds. So QQQ down 12% over the month. Now is a good time to buy. And so with that, take some money from your high yield savings account and buy a little bit. Don't use all of your cash. Now is not the time to break your CDs or cash in US savings bonds to put in the stock market. This way, if things keep going down, you can use a little bit more of your high yield savings account. And if we dip, 30, 40% in total, then you probably want to take almost all your money out of a high yield savings account to put in the stock market. If we go down even further than that, then you can look into cashing in those CDs or some bonds and buying even more. That allows us to do exactly what we all hope to do, which is buy low, sell high. And it's hard to be that disciplined. The sky is falling right now. Every stock is in the red and, you want to panic, but don't. This is the time that you buy low, and when markets are high, you diversify your portfolio and sell high. The second thing is paper towels. What does this represent? It's cleaning up your losses. So got some cleaning supplies here. It's now the time to harvest those tax losses. So let's say a few months ago you bought some stock and it's down $3,000-$4,000. You can sell that stock now, and you'll get in April, when you get your refund and you do your taxes, an extra $4,000 in capital losses will help you to save. If you're at a 24%, 32% tax rate, that'll be an extra $1,000 of cash that you'll have, in a few months. So now is the time to harvest those tax losses. And another thing to be aware of is the 30-day wash rule. So we don't want you to be out of the market. Just because you're selling an index fund or a certain company, we want you to find a similarly situated asset and buy into that at roughly the same time, so that if the markets shoot back up, you're still in the market. So, if there is a S&P fund that you're in, then look into a Vanguard fund that represents the S&P 500 as well. As long as it's a similarly situated asset, but not the exact same asset, then it won't trigger the wash rule. And why do you want to avoid this wash rule? Well, if you buy the same stock or the same index fund or the same asset within 30 days, then you cannot deduct those capital losses against your capital gains. And so it's just so important, when you have some losses, take advantage of it, cash out those losses and you'll get tax gains. Just make sure that you're not out of the market during that time period. So whatever money you get in return for that sale of stock or sale of the asset, put it back into the market into a similar asset. So if the market goes back up, you again will be buying low and selling high. The third strategy, got my oven mitt here. And that's because the third strategy has to do a lot more with psychology. And it's similar to when a little kid burns their hand on a hot plate. And what that means is we've all gone through these periods of stock markets going down, and we saw it in 2000, we saw it in 2008 to 2010, and then even during the pandemic in 2020 it went down. So most everyone was around here investing during 2020, and what you all know is if you stuck with it, in 2024, we are riding all-time highs. And so the lesson is when things go bad, don't sell. Remember, we want to sell high, not sell low. So the time to diversify your portfolio is when we're at record highs, not when we're going through the market downturn that we're seeing. So I use the oven mitt to represent learn from this experience, feel the pain. It is no fun to lose money, even if it's only on paper. And there are studies out there that say that it is twice as painful to lose money than it is to gain that same amount of money. So you're probably feeling pretty bad today if you checked out your stock portfolio and you saw it down a whole bunch, but it's okay. It's gonna rebound. Just don't act hastily. Don't react. You've been through this before and will most likely rebound. And if not, it might take a few years, but we'll rebound then. And that's how you use the buy low so that you can sell high. So just remember to experience the pain, feel it. It's okay. It will pass. This too shall pass. And so I'm really hoping that these three strategies are going to help you get through this market downturn so that when we next reach our all-time highs, you'll have succeeded in making as much money as possible. So remember to buy low. Don't use all of your savings right now. Use a little bit. Every time it goes down 10%, use a little bit more. Harvest those tax losses by selling and then buying another asset at the same time so that you stay in the market. Don't sell right now. Don't panic sell. This is just a minor blip. You probably won't even notice this in a few months on the graph when you look at it. But know that we are going to see more all-time highs in the next decade. Sit tight with your money. Keep putting more into your retirement. Things will be okay as long as you buy low, sell high, and make sure you're aware of the tax consequences of each of them. So we'll get through this market dip. That wraps up our current events news, one take, hot take, instant take. Thanks for joining us, and we'll see you next time.